Option traders are going to have a very tough time ahead. This is SEBI's consultation paper, which they published just 1 month ago. And in this paper, they have outlined 7 key changes that SEBI is going to undertake, which will change the option trading system altogether. Before taking major decisions, especially ones that affect the public, government authorities often ask for comments and feedback. And usually, nobody even takes the time out to read this consultation paper and after that, even give a reply or comment to SEBI officially about it. So in this video, first we'll talk about the real why. Why did SEBI come out with this consultation paper at all? Then second, we'll go on to each and every single point and we'll try and explain it in the easiest way possible. And third, we'll talk about our suggestions and our replies to each of the points that SEBI has given in this consultation paper officially through marketfeed, right? We've sent these as an official communication to SEBI through mail and we'll talk about why we feel it is the right way to do things. No matter if you're an option buyer or an option seller, a non-directional trader or a directional trader, we feel that this report and its proposals could have an effect on all of you. So make sure you watch this video till the very end because it does affect all of you and we have tried to simplify it. But if you have any doubts in between, please do pause the video and ask in the comment section down below. We'll make sure that you get an answer and reply for the same as well. So if you're here for the most practical finance and stock market content in India, get subscribed and let's get started with the video. The name is Ajay Ajith. Welcome to Marketfeed. So this presentation right here is for all of you to deeply understand what those 7 points really mean. Because when SEBI comes out with a paper, you usually expect it to be very simplified and anyone reading it, especially a trader, would understand it. But no, that's not always the case. We'll go through each point one by one here, explain it, then give our responses, right? So yes, first we'll go through the why of the consultation paper. So as per SEBI's words, the why is to help improve market liquidity and allow investors to help manage their risk better. What? Did you understand anything? No, right? So SEBI feels that there is a problem with liquidity in the market, that there are certain risks coming in the way of how the market is performing nowadays. And they also are deeply frustrated or deeply painful of all the losses that retail investors are making. So in the report, they say that 50,000 crore rupees is the amount that retail investors lost last year through options trading. Just think about that, 50,000 crore rupees. And who are the ones winning on the other side? It is mostly high frequency traders or algo players or even FIAs. That's how SEBI describes it, right? So that's what they're trying to attack with this paper. And yes, SEBI is trying to control 2 things in general to fulfill their way. One is high inflow of retail money into index options. They've given beautiful charts explaining how much more money is coming into index options and why they feel it is a big problem, right? And they're also trying to attack, and please note this point really well, hyperactivity around expiry days leading to volatility. Right? You might have all noticed that Wednesday and Thursday is mostly very volatile for the Indian market. And those are expiry days of Bank Nifty and Nifty respectively. Right? So they want to control this hyper trading activity around Wednesday and Thursday and all expiry days as well. So to do that, they've come out with 7 proposals. So these are the 7 proposals. Do not worry. We'll go through them one by one. So the first point, the first proposal is rationalization of strike price for options. Right? Don't worry, we'll explain it, right? So we'll go through a similar format here. So first we'll talk about what SEBI observed and their proposal, then we'll talk about our suggestion, right? So what SEBI observed under or when they were trying to propose this change was, SEBI noticed that a lot of positions are getting created 5 to 6% away from the current strike price, right? This means that people are trying to speculate on far OTM strikes. So in Nifty, let's say if Nifty is trading at 20,000 plus or minus 4% or 5% or 6%, SEBI saw that a lot of positions were being created in the option chain. Right? What does that mean? People are trying to speculate on very far away options, right? Maybe a 23,000 call option when Nifty is at 20,000. That looks very risky, right? And retailers are probably losing a lot of money to it. So that's what SEBI observed. So what is their proposal here? Their proposal is strikes to be uniform plus or minus 4% from the current strike price, from the current spot price, after which the interval between strikes will increase. So if Nifty is trading at 20,000 right now, plus or minus 4%, which is 20,800 and 19,200. Up to these two ranges, the strike prices will be uniform. It will be as what it is today, 50 price gap between or 50 point gap between each strike prices. But after that, the interval between strikes will increase. Right? So after 20,800, it might directly jump to 20,900 instead of a 50 point difference. There will be a 100 points difference. So what is our response here? We feel while the intent is clear, SEBI has not considered the context of implied volatility and its impact on hedging and speculation. What does this mean? Right? It means that when the market is trading very, very smoothly, when there is no volatility, then this might make sense. This 4% might make sense. But when there is a budget coming up, or when there is any other war coming up, right, or war news in the market, this implied volatility will shoot up, right? And that will lead retail option traders or even any option traders without enough speculative or hedging instruments. So you all know that in the case of any events which happen in the market, let's say even a Fed interest rate decision or higher volatility in this market, this 4% rigid structure, right? We don't find any problem with the flexible structure, but this 4% rigid structure would leave market participants without appropriate hedging or speculative opportunities. Yes? Hope that is clear here. So that is the first point by SEBI, and this is our official response. Now let's get to the second point by SEBI, which is an upfront collection of option premium from option buyers. So for this point, we did not have any concrete reply. In fact, when we went through the research paper or the consultation paper, what we understood is that a lot of brokers already implement this practice, and it is a good practice, right? So we have no problem with this, at least in the way that we understood, right? So I really feel that SEBI should be more clear in the intent and their messaging on what they're trying to convey, especially if they're trying to get feedback from retailers. Right? So that's my point here. So let's go to point number 3, which is removal of calendar spread benefit on expiry day. If you're a calendar spread trader, make sure you watch this very, very closely. Right? So what did SEBI observe? SEBI observed that calendar spread traders are having high basis risk and liquidity risk on expiry day, especially close to 3:30 p.m. Now imagine this is a wording being used in the official consultation paper. So let's try to simplify it. Basis risk is the risk that a hedge is imperfect and that losses in an investment are not exactly offset by the hedge. So let's say in the case of you trying to sell a call option, right? You sold a 24,000 call option, then you bought a 26,000 call option to hedge your current sell position. Do you think that by the buy which you place 2,000 points away, that will help you actually hedge your position, right? It will not. It is an imperfect hedge. So SEBI observed the same thing for calendar spreads. So if you're a calendar spread trader, you would know that you would sell options in this expiry and you'll try to buy a hedge from the next expiry, right? That's how the calendar spread strategy works. But SEBI observed that on an expiry day, there is not enough hedging being provided by that buying position that you took for next week. Right? And there is also liquidity risk because next week's options might not really be that liquid. Right? So these are the two things that SEBI observed. So in the case of a rapid spike in Nifty, let's say towards 2:30 p.m. or 3 p.m., your current week sell position, it will expand like crazy. But the buy position from next week, it might not move that much. Right? That is very simply put what SEBI has meant here or what SEBI observed here. And what is a proposal? Removal of hedge benefit for calendar expiry or calendar spread on expiry day. Complete removal of hedge benefit. Right? If you're a serious trader, you know that a hedge benefit often provides you with some safety as well as some margin benefits. Right? So that's what SEBI is trying to take away here. There will no longer be any margin benefits. You can still continue trading it, but I don't know, your ROI might be much lesser and you would not want to go ahead with this strategy if this proposal is enacted. So what is our response here? Calendar spreads with a hedge of closer expiry and high delta do not have the mentioned risk. Right? So what have we said here? If you're selling a 24,000 call option and you're buying a 26,000 call option, then yes, there is both liquidity risk as well as basis risk, which we explained earlier. But so let's say if you're doing a closer expiry, that means if you're trading the next expiry for the calendar spread and you're not taking that far off, right? The buy position or the spread position is not that far off, then we feel like it does not have the above mentioned risk, right? And higher margins could be required only for positions where the basis risk is particularly high or where liquidity is significantly lower. So SEBI can look at a case by case or a strike by strike level, and they can decide, hey, this strike or this position might be too risky, and hence this should not be given a margin benefit. Otherwise, you're just trying to avoid good players from coming into the market, right? And the entire market ecosystem might not be very enticing for all of these traders, especially ones who are making money, to come and trade on. And I personally feel that calendar spreads are usually traded by advanced players or someone who really knows the market. And for you to take away such benefits from advanced traders, that might not resonate with your why. What was your why, SEBI? Your first point of the why, it was that retail investors are losing money in the market. Right? But I feel like this will go directly against it. It will push more traders to take riskier positions and end up with more and more losses, right? So that's our response here. Now, this would address the identified risk without broadly penalizing on all calendar spread positions, right? Be a bit more specific, right? Do not go ahead and penalize everyone. That is our suggestion here. So then let's go to the fourth point, which is very, very important, especially if you are trading on any of the major brokers, right? So the fourth point is intraday monitoring of position limits. So what did SEBI observe? SEBI observed that there is a limit on OI imposed on brokers today that is called as a market-wide position limit. It is at 15%. That means no one broker should have more than 15% of open interest in the market at the end of any given day. Right? That is why you often see that Zerodha does not let you buy for OTM strikes, right? Because they want to make their traders happy and they want to keep this market-wide position limit or their contribution to the OI below 15%. That's what Zerodha wants to do. And why does this limit exist? It exists because no one broker should have the power to control the entire market, right? That is the idea here. And what is the proposal here? So SEBI has proposed a monitoring and enforcement of this 15% limit on a real-time basis. So if you do not feel like that is a problem, when I go to our response, you will understand that. So we feel like it is very, very dangerous. Serious traders would see their market-wide position limits being hit without warning in between a day. And they'll be stuck not being able to place any trades. That is definitely a very, very bad place to be in. Imagine you're trading one day, you're happily trading and you see an opportunity or you see a risk that is coming up and you want to take a trade. But then suddenly a notice comes up saying you can't place that trade. The limit is already breached, right? It might not be any fault of your own, but you would be stuck with that. And in that second, you'll have to transfer funds to a new broker. Maybe you'll have to, in the long term, even look for a lot of different brokers. We feel that it could be a very dangerous move if implemented. Hope you understand the seriousness of it. Now, the fifth point, it is minimum contract size. Now, this is very easy. SEBI has already set a minimum contract size for derivative contracts in 2015 between 5 to 10 lakhs. They are saying while the benchmark Nifty has tripled in this time frame between 2015 and now, this has not moved, right? This minimum contract size has not moved, indicating high implicit leverage. And what are they proposing? They're proposing an increase in minimum contract size to between 20 and 30 lakh in different phases. A 4x increase in minimum contract size. That's what they're proposing. What do you think about it? Make sure you pause and comment down below, because what they're trying to say, in fact, what our suggestion was, is that raising the derivative contract size to 20 lakhs will make hedging too costly for small investors, undermining the entire purpose of the derivatives market. In fact, it will once again go against the why, right? Which is hyperactivity around expiry days, as well as retailers coming into options trading. We feel this will push a lot of option sellers out of the market, right? Because option buyers still won't be affected. If you are paying 500 rupees or 1000 rupees for an option, buy trade, it will go 4x, right? Which means it will go up to 2000 rupees. But if you're still a speculator, you will continue trading that. But option sellers, if you're seeing a margin increase of this much, you'll be pushed out of the market, right? And we also feel This could force small option sellers to take on more risk or stop selling altogether, potentially pushing them out of the market and decreasing the percentage of profitable traders. Yes, that is what we feel. Currently, the SEBI report says that 89% of traders lose money in the market, right? FNO traders. And mostly these are retail option traders. And that is what they're trying to solve. And we feel like this will go against that. Why? If you're different types of option sellers will be affected in different ways. Some might be forced to take on more risk. If you had a capital of 5 lakh rupees, you're taking a straddle trade in Nifty with a margin of 1.5 lakhs. With this implementation, you might need to pay 4.5 lakhs for that same straddle trade. Right? So what does that mean? You'll be essentially taking more risk. Earlier, out of a 5 lakh rupees capital, you are only trading for 1.5 lakh. Now you'll be forced to trade for 4.5 lakh rupees and you'll be just taking on more risk. And in the end, the chances of that style of trader being profitable, it will reduce, thereby going against the why of the document once again. So SEBI should maintain a fair playing field by adjusting lot sizes to prevent or protect retail traders from excessive risk, which is already being done. You might have noticed that whenever Nifty or Bank Nifty moves up, the lot size of Nifty and Bank Nifty is often reduced, right? Nifty's lot size is 25 right now. Earlier it was 50. Why do you think this has happened? It is to maintain the minimum contract size between 5 to 10 lakhs. Right? Hope you understand that. And SEBI should just keep on doing that. I feel there is no further change that is required here. Now, the point number 6 is also very, very important. It is a rationalization of weekly index products, right? And they've saved the best for last. Trust me on this. So, what did SEBI observe here? Expiry days are almost entirely speculative. That's what their suggestion is or what they observed. And now we have 6 expiries on all 5 days. Which are these? We have Sensex, BankX, Nifty, Bank Nifty, we have Fin Nifty, we have Midcap Nifty as well. So all of these are leading to hyperactivity, leading to instability and a market risk overall. Right? So a lot of traders coming and taking a lot of speculative positions, it might make the market unstable overall. That is what SEBI is saying here. And along with higher losses for retail players as well. So more number of expiries can create more and more losses for retailers. That is what SEBI is saying here. So what is SEBI's proposal here? Weekly options contracts to be provided on single benchmark index of an exchange. That would mean NSE will have Nifty expiry and BSE will have Sensex expiry, and there will be no other weekly option contracts. Yes, there could be monthly contracts. So what did marketfeed respond here? Our response is that we strongly disagree. Nifty and Bank Nifty expiries used to be on the same day, right? There was no problems there. And they were providing crucial liquidity for hedging short-term risks, right? And we feel like removing Bank Nifty, right, taking away Bank Nifty could harm the efficiency and confidence of everyone on the market overall. And we feel, again, our suggestion here is a better solution would be moving Bank Nifty back to Thursday. Right? So there is no problem here. In fact, all of the problems that you stated earlier will be solved by this. A retailer who is losing money on a Wednesday, coming back on a Thursday and losing money again, that won't happen, right? So move back to the earlier structure where one exchange can have any number of expiries that they want, but they need to be on a single day, right? This could, again, we really genuinely resonate with the why. That's why I'm making this video, because I was also trying to understand the situation and I feel SEBI's why, 2 whys were really, really good. But the way in which they're trying to attack all the solutions is the only thing that we are disagreeing with. Hope you have that clear, right? So then let's move ahead into the 7th point, which is increase in margin near contract expiry. So we'll go to that. What did SEBI observe? Hyper trading activity around expiry day is leading to higher risk in the market. We have already discussed this, but this is not getting priced in. This higher risk, it's not being reflected in the prices. What is the proposal here? Increasing extreme loss margin by 3% on one day to expiry. That means Nifty expiries are on Thursdays. So on a Wednesday, if you're trying to trade a Nifty option, there will be an extreme loss margin of added 3%. So if you were earlier having 20,000 rupees as margin, right, to place a trade, now you'll be needed to put up 3% more. And on the expiry day, 5% extreme loss margin to be added. So while I understand where you're coming from, which is to take away naked option buyers and sellers out of the market, I feel that is not the way to look at it. Our response is very simple. In the hedge trading scenario, the risk is predefined. Let's go ahead into an example here to explain that. So these are real numbers based on last Friday. If you're to sell a 25,000 call option and if you're buying a 25,300 call option, right, you'll be getting a hedge benefit there. What is hedge benefit? Because your risk is limited, because you have a buy position just up above, you only have to pay a lesser margin, right? You only have to pay a lesser margin to the exchange. That is very, very clear. So then let's look at what would have been the max profit and max loss on the Friday's trade here. So max profit would have been 1,458, and in the case of any black swan event, your max loss would have been 6,000 rupees. This is how the payoff graph would have also looked. That means any place, if Nifty moves anywhere beyond, let's say 26,000, 28,000, 30,000, still your max loss would only be 6,043 rupees. But how much margin are they charging already? There is already an extreme loss margin of nearly 1.5 to 2% added into index options. And after everything, span plus exposure, everything, the required margin right now is 19,397 rupees, right? What is the max loss? In the worst case scenario, you can lose 6,000, but currently you're going to put up 19,000 as margin. And right now that is a status quo. Everyone is happy with that. On top of this, why does a trader have to give up additional margin? There is just no logical sense into that. Right. So hope you understood the 7 points in detail and each and every one of our responses against them. Right. As we said earlier, marketfeed and myself, we truly believe in the why of the consultation paper, but the proposals and the way in which they're going to be controlled. Right. That is what we have a problem or a difference with, and all we can do is to give out these suggestions, right? And as logical traders, we should definitely be a part of the system where if any consultation paper comes out, we should make sure we read through it entirely, try to understand what it means, and if possible, if it is within your capabilities, you should try to give a response to the same as well with your suggestions on why or why not it should happen or the proposal should go ahead. That's why even we decided to send in that email into SEBI. Yes, so I do understand that the video was slightly complicated and it is for serious traders. I wanted to keep it under a certain time limit, right? I did not want it to be too long. So that's it for the video, guys. Make sure you hit the like button. If you like the video, make sure you get subscribed if you want to see more content like this as well. And as always, leave your comments down below on what you think of this consultation paper and each of the 7 points here. And let's make sure the retail participation that we are seeing on the Indian markets today, those are intelligent traders who are capable of giving intelligent suggestions to the ecosystem as well as the regulator. This is Ajay Ajith signing off. See you all again in another video. Bye bye.